the larger segment of market by market cap is not delivering commensurate earning growth, and that's where money has repeatedly flocked to mid cap and small cap, where the earning growth has been higher. Because of this repeated flow of money.
So, if you're against this entire backdrop, how are you positioned in your funds? Are you making any changes across the spectrum in terms of sectors? Hello, investors. Welcome to Moneynomics by Axis Mutual Fund. I'm Shalini Gautam, and I have with me our head of equity, Shreyash Devalkar. Today, Shreyash will be talking to us about the key developments in the market, the earnings season, how has it panned out, and how does he see the risk reward across market caps. So, Shreyash, let's begin. First, let's talk about the earnings season that we are seeing currently. How do you think this season has panned out so far?
See, for this result season already it has started. The expectations is actually one of the highest top line growth for listed companies. It is partly helped by price increase, inflation, and this revenue growth is actually expected to be one of the highest in last 2 years or so.
Yes.
This, as I highlighted, it is being helped by price increases everywhere. Uh, the impact is seen in, say, credit growth increase. So credit growth is upward of 15% or there is an element of shift from bond market to bank, but also in addition to that, the SMEs are borrowing more. Working capital lines are getting drawn more. So there are multiple reasons why it is increasing. Uh, Apart from that, if you take most of the category where there is a price increase, it is getting reflected. Having said that, as far as the bottom line is concerned,
Yeah.
there the uptick is not going to be as good because obviously this price increase is happening more because of the raw material price increase. And as of now, there are sector segments where price increase is at least trying to cover the margin impact, but there are multiple sectors where it is not, and that's where, just to give example, like sectors like auto OEMs, their margin decline is expected almost 150 basis point, 200 basis point or so, and likewise many other sectors, this margin decline is expected, and accordingly the PAT growth impact is not as high. If the commodity prices, which is falling already, at least till 2 weeks ago, till the point in time when this war-related news resurfaced. This, if it corrects from here, all those prices, then definitely that is a good news. But the recent development has not been as great on that front.
Okay. Let's talk about how do you see the risk reward across market caps?
Risk reward wise, market has actually followed earning growth so far, and that's what is expected to follow. But the only divergence which has happened here is because the larger segment of market by market cap is not delivering commensurate earning growth, and that's where money has repeatedly flocked to mid cap and small cap, where the earning growth has been higher. Because of this repeated flow of money into that segment, their valuations has reached level where on an absolute basis it becomes very difficult to justify. On a relative basis, one can always say that yes, this is growing 15, 20, 25% mid and small cap. So one should invest there, while large cap is growing, say, 8, 10, 12%. But the multiple difference is now getting starker. And that's where, assuming that the nominal GDP growth improves, because of which the top line has started improving, and it percolates into bottom line as well with the correction of raw material prices. That is the scenario in which one may get good returns in large cap as well. So because their risk reward is favorable when it comes to its relative multiple. In most of these cases, take private sector bank, FMCG, IT, and multiple other sectors which has more representation in large cap, their multiples are either closer to pre-COVID level or at the most 15-20% higher compared to the pre-COVID level. And that's where, as I said, the valuation wise risk reward is favorable, but the growth part has to fall in place. Without that, or never, market just doesn't give reward just based on the valuation.
Absolutely.
On the other hand, in case of mid and small cap, there are good stories. There are, especially in the manufacturing space, renewable power, etc. Though, including hospitals. So it's not only about B2B or manufacturing. There are multiple stories in consumption as well. So those stories and those themes are continuing to grow. Only the issue out there is the multiples are high, and that's where, despite higher earning growth in mid and small cap, the returns are higher than the large cap, but absolute returns are not as great as the investor would have imagined looking at only the bottom line growth number. So this is where the conundrum of the market is, and that's where what we are suggesting is have a diversified portfolio with categories like likes of multi-cap, flexi-cap, large and mid-cap, so that you are invested in the both end of the market, where there is a growth with high valuation and there is relatively low growth with reasonable valuation.
Absolutely. Completely agree with that. So, if you're against this entire backdrop, how are you positioned in your funds? Are you making any changes across the spectrum in terms of sectors? Could you elaborate?
The changes which we have been making for last 5 to 6 months, the key ones has been increase in the lenders as far as portfolio allocation is concerned, pharmaceutical, healthcare, including hospitals, and part of bottom up stories in auto ancillaries especially. While we already had a good exposure to capital goods, especially in the mid and small cap oriented schemes, where we might have done some profit booking, but broadly that exposure remains. Uh, in addition to that, the sectors where we are underweight are metal mining is the one where we are underweight. Apart from that, oil and gas is where we are underweight, and IT is where we are underweight.
Okay. We again saw the West Asia crisis resurface, and the ceasefire did not continue for long. Oil is again, moving towards it's above $80. How do you see this crisis panning out? Now it's been quite a few months. So, do you think that the sentiment is now a little more upbeat than it was previously, and have investors discounted this conflict?
Sentiment is more upbeat, more because of the underlying resilience which economy has shown, which is getting reflected in the numbers. Whether it is volume growth of auto OEMs or credit growth and multiple surge indicators. So on when you look at this some numbers, then definitely the sentiments are more upbeat because of this, because it gives comfort over the resilience of the economy. However, with resurfacing of this issue and crude going back closer to 85 90s, in my judgment, yes, that is going to be a tricky situation, because crude going upwards of 90 is definitely would halt some of the momentum which market has gained. But certain steps which government along with RBI has taken on the monetary policy day to attract FI approach, that is reasonably good news. And at least yesterday's release suggested that almost $17 billion we have already got. If the trajectory continues, I think that would lend some support in case this war-related news flow escalates. If it doesn't, then definitely I think we are in the good market.
Okay. Thank you so much, Shreyash, for your insights. And a big thank you to all us investors. Stay invested.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.